But please, if you start to see this stuff happen, please reach out. We'll bring you on for a special interview so that we can let folks know, hey, we're beginning to see some of these early signs.
Absolutely. Yeah. And I would just point out at a major bear market low, you do not see insiders being extremely cautious and lack of buying, and at the same time, record inflow into leveraged long ETFs like we see today.
Yeah.
Retail investors have never been more bullish than they are right now. I mean, the record flows into leveraged long ETFs tells you that there's still a buy the dip bid out there that is very, very strong. And that's not something that you see at major lows. I would just point out too that that insider sell to buy ratio, the 13-week ratio, did dip down into bullish territory back in like April of 2022. But it took that ratio staying that low for another 6 months before you got a good signal on the longer term 12-month ratio. So we haven't even gotten that early signal, insiders starting to get bullish yet. So that would be the first thing I'd want to see. But that would also suggest that you need to see a good 6 months of that kind of insider bullishness before you can have confidence in the idea that 18 months, 2 years from now, the economy is going to look a lot better. Earnings are going to look a lot better than they do right now. And we haven't even gotten that early sign yet from insiders.
Okay. Well, if you don't mind, Jesse, let's trundle over now into the okay, so what part of this, which is all right, I'm a investor, I'm watching this. Um, Jesse's outlook makes a lot of sense to me. Seems like I got to get kind of defensive, at least for, the next couple of months, at least, maybe longer. Um, Besides kind of the obvious defenses, parking in T-bills, et cetera, um, are there any potential strategies or particular asset classes right now that you particularly like? We haven't talked about gold yet, but that kind of played into your whole geopolitical and economic paradigm shift where, some of the issues with the treasury market you thought were somewhat, partially at least responsible for the run that gold's been on. How would you think about playing this environment?
Well, I think, there was an interesting piece Bloomberg put out a couple of weeks ago, talked about is the diversification bear market over, right? And I think that's a great way to think about things, that it's been diversification has been a losing strategy for the last 15 years, really since the markets bottomed in 2009. All you needed to own was the S&P 500, or whatever, FANGs, Mag 7, the less diversified, the better, the more money you made. I think now we're in an environment where diversification is going to be much more important, and not diversifying just across the stock market and say, well,
Right.
maybe I shouldn't just own the Mag 7, maybe I should own all stocks, maybe I should own some, diversify into other equity markets, right? We've seen foreign equity markets start to outperform the US, but also into other asset classes. I've been bullish on gold for the last 10 years. I think it's been a wonderful diversifier and has actually outperformed the U.S. stock market over that time frame. Gold now, I think, it's important to say, ask, what is gold trying to tell us? And I think that's what we've been talking about to this point is, the gold is saying, we are potentially headed for a debt crisis, some type of, this type of a thing. But when I look at gold relative to a lot of other asset classes, to me, it's starting to suggest that things like oil are really attractively priced right now. The oil to gold ratio has been really handy in understanding, do I want to own energy stocks or gold miners right now? And when that gold to oil ratio has gotten really high, it's been a great time to transition out of gold miners and into energy stocks, and vice versa. So back in 2022 was a great, this indicator told you it was a great time to get out of energy stocks and get into gold and the miners. And that was a great signal. Right now, it's saying the opposite. Right now, it's saying the gold and the miners are potentially overvalued relative to the rest of the commodity space.